All right, let's jump right into this explainer because the Forex markets have been delivering some absolutely wild price action this week. And right at the very center of it all is a massive anomaly taking place in the southern hemisphere, the New Zealand dollar.
To kick things off, we are decoding a massive financial paradox today. I mean, how does a currency absolutely crush the broader market while its own domestic fundamentals are clearly cracking? It's exactly the kind of setup that traps unsuspecting traders, but heavily rewards those who actually look past the surface-level price action. So we're going to peel back the layers on this New Zealand dollar rally, investigate the hidden drivers, and figure out if this strength is built on a solid foundation or if it's literally just a mirage.
This week's Forex landscape, let's look at the winners and losers.
So mapping out exactly where the capital flowed over the past week, non-US currencies completely dominated the board. Down on the weakest side, the Swiss franc suffered some really deep volatility, experiencing wide swings from a steep drop early on to a late-week rebound. And right next to it, the US dollar stayed persistently weak, operating in the red pretty much all week long. But look at the top performers. The New Zealand dollar took the absolute top spot, showing incredible trading elasticity. I mean, after dipping on Tuesday, it pulled off this relentless climb, hitting new highs by Friday and leaving plenty of room for swing trades. The British pound and Australian dollar followed closely behind in that strong tier.
And this brilliantly illustrates that the core contradiction driving all this price action was actually the widespread weakness of the US dollar itself. If you overlay the charts, almost all major non-US currencies followed a near-perfect synchronized path. They dipped early in the week, bottomed out around Wednesday, and aggressively rebounded Thursday and Friday. It's literally a mirror image of the US dollar index. So the main story here isn't necessarily that the rest of the world suddenly got incredibly strong, it's that the dollar got weak.
Moving into Section 2, the hidden dollar driver, and those cooling Fed expectations. So what actually sparked this massive dollar sell-off? Well, it was a barrage of US economic data, and it was all pointing in one single direction: cooling. Inflation data continued its downward trend, and retail sales straight up missed market expectations. This double hit fundamentally shook the market's belief in further aggressive tightening from the Fed. Because of that, U.S. Treasury yields were suppressed, and the dollar index dropped to a 2+ month low. You know, the capital had to go somewhere, and it started rapidly fleeing U.S. assets.
To put some numbers to that sentiment, market pricing now reflects a massive 70% probability that the Federal Reserve is just going to maintain interest rates in September, choosing not to hike at all. That is a dramatic shift in sentiment compared to just the beginning of the month.
That brings us to Section 3, the decoupling anomaly, or what happens when you ignore the anchor.
Now, the absolutely crucial point here is how this single-minded focus on the Fed caused the market to completely ignore normal regional anchors. Normally, weak economic data out of China would immediately sink the New Zealand dollar, right? Given their close trade ties and the NZD's status as a commodity currency, it's usually a one-to-one reaction. But this week, traders completely brushed off that bearish news. The market has seemingly fully priced in China's economic slowdown. Their attention is so intensely fixated on U.S. policy shifts that the usual gravitational pull of Chinese data had zero effect on the surging Kiwi.
Which leads us to Section 4, the interest rate illusion, driven by a hawkish RBNZ. You see, with capital fleeing the US dollar, it obviously needed a high-yield home. Enter the Reserve Bank of New Zealand. The market is currently pricing in an 85% probability that the RBNZ will hike rates by 25 basis points at their early September meeting. So while the Fed is cooling down, the RBNZ is still running hot.
And it actually doesn't stop with just September. Some institutions are going out on a limb and betting on an extended cycle, pricing it up to 3 cumulative rate hikes by early 2027. This aggressive, hawkish stance makes the New Zealand dollar incredibly attractive to carry trade funds looking to borrow cheap and park their cash in high-yielding assets.
What this does is build a massive interest rate differential. On one side, you have the U.S. Federal Reserve, whose rate hike cycle is widely perceived to be nearing its end. On the exact opposite side, you have the Reserve Bank of New Zealand actively maintaining a hawkish cycle. This gaping policy divergence acts as the internal engine for the NZD's passive, gravity-defying rally. And I say passive because the New Zealand dollar isn't really rallying on its own economic merits. It's just being pulled up by this specific interest rate dynamic in a weak dollar environment.
But hold on, let's hit pause for Section 5. Weak fundamentals exposed, or what we're calling the false fire.
Before you go adjusting your trading positions and betting the house on the Kiwi, we really need to expose the false fire behind this perceived strength. If we look closely at New Zealand's domestic data, the whole narrative shifts. Yes, the July Services Index stabilized just above the boom or bust line, but the underlying details, they are grim. The employment component within that data is experiencing continuous contraction. The domestic economy is merely stabilizing at best. It is incredibly far from a robust recovery. Because of this, sustaining any rally above the 0.59 level is going to require genuine, fresh, fundamental catalysts, not just relying on a weak US dollar.
Adding to that rather fragile reality, over 60% of surveyed local enterprises in New Zealand hold a pessimistic view of their operating outlook. You simply cannot have a structurally dominant, long-term currency bull run when the very businesses driving the local economy are bracing for tough times.
So let's distill this down to a crucial takeaway. The New Zealand dollar surge is heavily reliant on a rising tide lifting all boats dynamic. It is driven by the falling US dollar rather than its own inherent strength. It's relative strength for sure, but definitely not absolute strength. And what this means is that if the US dollar rebounds, or if the local New Zealand rate hike expectations soften even a little bit, this entire house of cards is highly vulnerable to a very sharp, painful pullback.
Which perfectly sets up Section 6, the Jackson Hole cliffhanger, as we look to next week.
Because that threat of a pullback, it's much closer than you might think. All eyes are now turning to the Jackson Hole Global Central Bank annual meeting next week. Now, this isn't just any conference. It's a pivotal summit where the Federal Reserve's chair's speech has a long history of completely resetting global market interest rate expectations. If the Fed looks at the data and decides to deliver a surprisingly hawkish signal, it could instantly trigger a massive US dollar bounce. And as we've just established, a strong dollar will immediately crush this non-US currency rally.
So, as you manage your risk and position yourself for next week's volatility, you've really got to ask yourself, is a hawkish surprise at Jackson Hole waiting in the wings to crush the NZD's false fire? Is this Kiwi surge genuinely built to last, or is it just a magnificent illusion that's about to meet a harsh economic reality? Keep a close ear on those central bank officials next week, because the answer to that question is going to dictate the entire board.